Hi, everyone. Thanks for joining me. I think we're going to go ahead and get started. So thanks so much for coming today to our What is at Risk and Why is it Important webinar. We'll go ahead and introduce myself. My name is Sarah Nyheisel. I'm an implementation manager here at RedTeam, and I've been with the team for about 4 years, all of that in implementation. So I do a great deal of training on the product, and I'm really excited to bring this topic to you today because it's one that I'm really passionate about. Just to kind of emphasize and make sure that everyone's in the right place today, I did want to make sure everyone's aware that this specific webinar is tailored for RedTeam Flex. So you probably won't know what at-risk is if you're a RedTeam Go user or if you're using any of our other platforms. So just making sure that this is our flagship platform, our full-scale project management platform called RedTeam Flex is what we're going over today. And what we're going to talk about today is first and foremost, what is at risk? Why do we call it that? What are some alternate terms that you may be familiar with? And how do we use it? We're going to talk about how and when to manage your at risk, some convenient times and best practices. We'll talk about the consequences of mismanagement and what happens if you're not keeping an eye on it. And then we'll have some time at the end for Q&A. So I will have both my chat and the Q&A open on my other screen. If you have questions along the way, please feel free to drop those in there. But I am going to kind of hold those until the end. Shouldn't be a terribly long webinar today, and we should have plenty of time at the end to get to any of those questions. So the first thing we want to talk about is what is at risk. Now we're going to be bouncing back and forth today between our slides and an actual sample database so I can show you what things look like in one of your projects. But I wanted to start off by kind of defining this for you. So at risk is a term that we use within RedTeam Flex very specifically. You may be familiar with it by other terms such as costs to complete or forecasting, estimate to complete. All of those terms are pretty similar to the way we use at risk. But I've put a definition in here that comes directly from our Help Center article, which essentially says that we intend that at the beginning of your project, everything that comprises your budget must be purchased or performed in order to fulfill those prime contract requirements. And if you've yet to write a commitment for those, we consider those dollars or those budgeted dollars to be at risk for the general contractor. So you hold the risk on those dollars and on those costs until you've bought them out with a subcontractor or with a purchase order. Once that's signed on the dotted line and executed, we would then consider that risk to be transferred to that subcontractor or supplier. So that's where we get the term at risk from. And what we would intend is that that at-risk amount is reducing on each of your line items as you move through the project. Now, who plays into that and how do we benefit from at-risk? Project managers are primarily the ones who are managing at-risk through their project budget tab. And their job is to use that at-risk, that forecasting or estimated cost to complete, to gauge project costs, actual project costs in relation to their budget and kind of keep on track, see how they're doing. Whereas executive leadership is going to be able to use that at-risk value to project profitability in real time. So if the PM is doing a great job of managing at-risk, executive leadership is going to be able to do a great job of seeing that information in their financial reports in terms of projecting profitability. So let's hop over to a sample project and let's take a look at what we mean when we say at risk. What I'm going to do here is I'm going to review some basic budget columns and make sure you know what they are. Hopefully, up to this point, you knew what I was talking about when I said at risk, and you knew I was referring to a budget column here. If not, you're going to bring a lot away from this webinar, right? Because if that wasn't a familiar term to you and you didn't know where to find it yet, chances are you don't have a solid strategy for managing it. And that's what we want to help you develop today. So you can see here, starting with our estimate column, these are all filled in as we create an estimate and a proposal. Now, in the event that you're one of those folks who's doing your estimating elsewhere, it's okay if this entire column starts out as zeros. You're not going to have an estimate in here if you didn't build it in RedTeam, in which case you'd be just filling in your baseline budget. However, in this case, I built an estimate, and you can see that those numbers pushed through into the budget as I promote from request through proposal and to in progress, those budget numbers become identical to the estimate, right? And we expect that those should stay static throughout the project unless you've got an authorized change order that's altering them, or if you're making a budget adjustment. Remember, the two basic reasons we'd see a budget adjustment in this column would be if we need to shift money from cost code to cost code, or if we're making some kind of executive level override. We're saying, we kind of fudged that number. It's not a realistic number for our team to shoot for, but we're not going to process a contract change and charge the customer for that, right? It's just something where we want to give our team a more realistic number to shoot for, and we're okay if that's eating into our profit margin. Next to that, we're seeing our actuals and our open columns. Now, these columns are automated. And when we talk about the actuals column, that is money spent. So what you're seeing here is vendor invoices that have been committed, along with any timesheets and expenses that you may be putting in. And in addition, for that matter, any adjusting entries that you may put in through the transactions tab. So all of your dollars spent will be here in the actuals column. And then you've got the open column, which is tracking all of your committed costs that have not yet been spent. So you can see as an example here, I wrote a $5,000 subcontract for this payment and performance bond line. And as I get a $2,500 invoice, that money is actually shifting from the open to the actuals column. So as I commit subcontracts, purchase orders, even labor or expense authorizations in the buyout tab, those show here in the open column, and as they are invoiced against, or as a timesheet or an expense is logged against those authorizations, we see the money shift from the actuals to the open column. Which leaves us with at-risk and contingency here. Those are our two manual columns. The at-risk, like we said, is a forecasting column. And you can see here at the very beginning of the project, let's find a good line item, right here, this permit allowance, for example. This is how we would expect it to look at the very beginning of a project, where the estimate, the budget, and the at-risk numbers all match. Now, I will say another caveat for those who are doing estimating elsewhere: if you're building your baseline budget yourself, you're not going to see those numbers copy automatically into the at-risk. But we would want you to go ahead and start your at-risk, generally speaking, at the same amount as the budgeted value. And we do that because we assume you expect to spend what you budgeted on day one of the project. When work is first authorized, we expect I will spend what I budgeted, or I would not have budgeted that way. And right now, all of that is at risk for me as the GC, because I have not contracted anyone to be responsible for any of those costs. Now, as the project moves on, we would hope that as you're committing and spending money, you are reducing this value appropriately. But it's not a simple subtraction calculation. It's really about an in-the-moment, real-life assessment of what we're going to spend. So I can click on this at-risk number at any time, and I can make edits. So I can come in here at any point in time, and this one is actually split out through a few different scopes, right? We've got change orders on this project, but we can come in and make edits to our at-risk. And that's going to allow me to say, as I commit money, I will reduce my at-risk. But the reason we leave this manual and we don't do the math for you is because we want this to be a moment of critical thinking and decision-making for your project managers, where they have the ability to say, actually, I achieved some buyout savings here, and I'm going to come in under budget. Or I know that I budgeted $340.59, but I'm aware that costs are running over. I'm going to need to spend an extra $200, right? Now, this is on a really small scale, but it's allowing me to project where I'm going to end. And that's because the estimate at complete here, this complete column, is totaling up what I have spent, what I've committed to spending here in the open column, what I estimate I will spend in the at-risk, and showing me that plus any contractor's contingency, which we'll talk about in a moment. It's showing me where I will end the project, right? Where I will finish. So I can go ahead and compare that complete number to budget to see in my over under, where will I be at the end of the project? Not today, but at the end. And if I'm managing at risk properly, I'm getting a great understanding of where I'm running over and where I'm achieving savings. Now, I do want to mention this foot to budget option. For those who have seen it, wondered about it, used it before, this is kind of a do the math for me button. This is the I intend to stay on budget button. So I would not say don't use it, right? There are good situations to use it. I would say do not overuse it. You want to make sure you're thinking critically about whether this situation is the right one to be using foot to budget. I can tell you, our founder, Mike Wright, actually argued somewhat against adding this button because he saw it as the potential for project managers to kind of hit it as an easy button, right? I'm on budget, I'm on budget, I'm on budget. I don't want to take this moment. I don't want to pause and do my critical thinking. I'm just going to go ahead and say, yep, do the math. Now, I want you to have a literal definition of what this is doing because it's going to help you understand when you should and shouldn't use it. So foot to budget quite literally means, please make my over under equal 0 by adjusting my at risk. So in this case, if we were to say foot to budget, let's say we've already spent $100 and we've got another $100 here in the open column. When we hit foot to budget, it's going to say 340.59 minus 100 minus 100 equals 140.59. It's going to tell you have $140.59 left available in your budget in order to track on budget at the end of the project. That's great if I really truly intend to be on budget. But if I don't, I need to make a better realistic assessment, right? I've spent 100, I've committed another 100. I either don't think I'm going to need that 140 or I think I'm going to go over, and I make my best judgment call and put that in here. And that can be edited at any time. We'll talk about management strategies here in the next bit. But the other thing to be aware of is that if I hit foot to budget and I'm already over budget, it will put a negative number in my at risk in order to achieve an over under of 0. Now that's not really possible. Realistically, you can't expect to spend negative money and end up on budget if you're already over. The only situation I can conceive where you'd want to see or could see an at risk with a negative value would be if you know there's a credit forthcoming that has not been put in the system yet, right? I know there's a credit coming back to me and I haven't reflected that yet. That might be a situation for negatives. But other than that, if you're seeing parentheses in your at risk, you should be thinking hard about whether they belong there. Most often, that is masking an over budget situation, and you're either going to want to come zero this out, or you're going to want to put in the positive dollar value that you still expect to spend if you're planning on going further over budget. So that's really the essentials of what the at-risk is and how we make edits. The last thing I want to talk about before we go on to management strategies is this contingency column here, this contractor's contingency. Now, I want to be clear, this is for contractor's contingency, not for owner's contingency. You see this line item up here for owner's contingency, that's exactly how we expect that to be handled. We would generally expect a separate cost code to be placed into your budget and or your estimate to account for that owner's contingency money. That makes it really, really easy when you create customer change orders to shift that money from the contingency cost code down to the cost codes where you're going to be spending it and gain owner approval, right? So that's owner's contingency. Over here is an optional contractor's contingency. You don't have to use it. I have plenty of clients for whom these numbers stay zeros the entire project. That's fine. But we do have some clients who like to represent their own bucket of contractor's contingency per line item, and they can set aside that cushion. So you can see what we've done here is we've budgeted $45,000, and we actually shifted $5,000 of that over into contingency to say, this is my spare money for this line item. I'm not quite ready to declare it as profit. I might need it, so I'll keep it here in contractor's contingency. Now, you can click on this number in the contractor's contingency column anytime you'd like and come in here and make edits. But I've got a pro tip for you. If you like using contractor's contingency, I actually prefer not to edit from this window because you can see I can only adjust the contingency column. And realistically, if I'm changing contractor's contingency, I'm quite often changing at risk as well, because this would have started out at $45,000, which is what I budgeted. And at some point, I moved early in the project, probably, I moved that $5,000 over here to contingency. And then the decision becomes, well, either I'm going to spend it and I would eventually move it back to at risk or into the at risk for another line item, or I'm not going to spend it and I would zero it out in order to show myself as coming in $5,000 under budget, which is going to give me that added profit in my financial reporting. But if we go back here and I click on the at-risk number for the same cost code, this gives me the ability to adjust both. So I could shift 45 down to 40, put that 5,000 in here and save. And if I do decide I'm going to spend it, I can come back in here and zero this out and reset this one back to 45. And that's going to allow me to very quickly move that money back and forth without having to open multiple windows and screens. So we'll save. So that's really everything I want you to know about the various budget columns. We'll kind of finish up there, right? We talked about estimate at complete. This is everything east of the budget column. Actuals, open, at risk, and contingency summed together. If I spend everything I have forecasted and everything I have sitting in contingency, where will I be at the end of the project? And therefore, how far over or under the budgeted amount will I be? So let's go ahead and move on then to how and when to manage our at-risk. The key here is that you are going to want to develop your own strategy as a company. It's rare that I see two clients who manage at-risk exactly the same, right? I'm going to walk through with you kind of our ideal case, what we intend, the reminders we put in there for you. But we have plenty of clients who manage it in various ways. And really the key is consistency. You want to make sure that each of your PMs is managing it in the same way, whether that is based on the red team reminders we're going to show you and when those pop up, or whether that's based on a periodic review. I do have clients who say my PMs are just going to go into the budget and review their at-risk every Friday. It kind of runs the gamut. We're also going to talk about a specific situation, somewhat rare or should be rare, but if your project needs to be demoted from in progress, we'll talk about how you can kind of memorialize those current at-risk numbers, because demoting your project is actually going to wipe your at-risk clean and reset it, and you'll need to be able to place those numbers back in as you re-promote to in progress. So two places we give you reminders would be as you're creating a commitment. That would be a subcontract or a purchase order in the buyout tab. As I add committed dollars to the buyout tab and I put those forms in a committed status, that's when I'm going to get that pop-up asking me to adjust my at-risk. We're also going to see a shortcut when it comes to non-commitment invoice approval. We can go ahead and adjust our at-risk as we bring in invoices that never had a commitment. The money never showed up in the open column. It simply shows up in the actuals column as we get a temporary toilets or temporary utilities invoice. We would then want to adjust that at risk as well. So let's go take a look at where those two reminders come in. So what I'm going to do is go to the buyout tab here. And we're going to look at this masonry subcontract. So I've already got quite a bit of money committed into this masonry subcontract, but you can see I've got a draft change order right here. So I'm actually just going to commit that to show you the reminder that I'm going to get as I commit any new subcontract, purchase order, vendor change. The same would be true if you're committing a labor or an expense authorization. As you're adding money to the open column, it's going to ask you if you'd like to adjust your at-risk. And there's our pop-up here. This is going to be the same screen we just saw when we were in the budget tab. However, I do want to point out, this is really key when it comes to managing your at-risk, is that at-risk is managed by scope. So I have a lot of clients who will come here and get confused, right? I don't see any money to reduce. How can that be? We are processing this vendor change as part of owner change 03. So that's the scope we need to go to. You need to align your scope in terms of the prime contract. So we wrote that $18,000 commitment for masonry to scope 03 of the prime contract. And that's why we see it here in scope 03. I'm going to show you a filter technique for your budget that can make this really easy to visualize. But it is another common pitfall where folks will try to adjust their at-risk and not realize that they need to be looking at the correct scope, depending on where that commitment falls. So you can see here, I budgeted $20,000 for this change order and I just committed $18,000. This is my moment to decide, am I going to spend that extra $2,000 or not? Hopefully the answer is no. I achieved some buyout savings and now I'm going to zero out that at risk and it's going to show me as coming in $2,000 under budget on this scope and cost code, right? So for masonry, change 03, I'm coming in $2,000 to the good, and that's going to increase my projected profitability. But in real life, there might be situations where I know I need to buy out another $3,500, right? And as I put that in here, I'm going to see $1,500 over budget at the end of the project, right? So it's totally up to me. I can go ahead and manage that as I see fit. We're going to be optimistic and say that we're coming in under budget. We've achieved some buyout savings. As we save that, we'll go back and look at our budget to see the effect that that's had. So we're going to go down to our masonry line item. We're going to see we only have about $3,500 left in our at-risk. This can be tough to visualize because you're going, where's that $18,000 that I just committed? This is across all scopes. That's our general view of the budget. But if we filter and group by scope, we can then see how the at-risk is managed for masonry. You can see that we had already zeroed out the at-risk for the original scope. We bought all of that out and we've even spent some of the money. We can come down then to change order 03 and see that masonry number. We budgeted 20,000, committed 18. We're not going to spend any more. And therefore we're coming in $2,000 under budget. So that's one point that we can manage it. And it's a really convenient point. However, if the person writing your subcontracts and purchase orders isn't the project manager, they may not have the knowledge to make those adjustments at that time. So I am not forced to make an adjustment to the at-risk when that reminder pops up. I can leave it as is and hit save. That's fine. But we'd need someone else, the project manager, whoever does have that knowledge, to come back into the budget tab at some point after that buyout is written, that commitment form, and adjust the at-risk manually. And that's where I say I have clients who either A, don't write a lot of commitments, they're just getting a lot of standalone invoices, or the person writing those subcontracts or POs doesn't have the knowledge to be managing the at-risk because they're an admin assistant who writes these when they're told to. They don't necessarily have the day-to-day knowledge of how costs are falling out on the project. So those are situations where you might say, hey, for our company, makes more sense for my PM to come in weekly or every few days to adjust at-risk values in here as they see fit. Now let's talk about that second reminder, the standalone vendor invoice. This would be if I'm entering an invoice for something like I said, temporary utilities, temporary toilets, anything where you didn't write a subcontractor purchase order. You expect or budgeted, let's say 6 months worth of dumpster rentals, but you didn't write a PO for it. You're just going to get a monthly invoice for dumpsters. You would come enter that invoice and say it is not related to any open commitment. So let's go take a look when we go to our vendor invoices page. And in fact, you can get there from the home icon. So I'll show you that method because it's a little easier. We hit the home icon, we go to vendor invoices for this project. And what I want to show you is in that invoice approvals process, at the final step, that confirmation step, we are going to be able to see a shortcut to adjust our at-risk. So if we go ahead and open any of these invoices and come down to step 6, we have an adjust the at-risk button. And if you've ever wondered why that's here, it's intended for those situations where we have a standalone invoice. We didn't write a subcontractor PO, and therefore we didn't get that earlier reminder to adjust the at-risk. we are simply dropping that dumpster rental invoice into the actuals column, and we need to remove ostensibly 1 month of dumpster rental money from the at risk. But again, that's our moment for realistic assessment. Is the project still on track to be done in 6 months? If not, I probably need to up the at risk and make sure that I'm accounting for, hey, I expect 8 months of dumpster rental invoices rather than 6. I've received 1, I expect 7 more. And that's giving us that realistic projection of, hey, we're going to run over on dumpsters because the project is behind, whatever the case may be. But you've got that adjustment opportunity here. You could use it for a commitment-based invoice if you know you didn't adjust your at-risk earlier, but it's intended primarily for those standalone invoices where you say, hey, I didn't get an earlier reminder because I didn't write a commitment. So those are the two options for kind of standard reminders. We talked about that periodic review if those reminders just aren't well placed for your workflows. That's when I would say, hey, let's make sure that we build a strategy, right? But no matter who you are, whether those reminders work well or periodic review works well, I would encourage everybody on the call today to develop an SOP for at-risk management for your company that works for you so that everybody's doing it the same and you can be confident that your financial reporting is giving you the most accurate information. Now, the last thing we want to talk about here in terms of managing at-risk would be in the rare event that we need to demote our project from in progress back to proposal or request. One of the few things that we are going to lose if we move backwards is the at-risk value here. We're going to see that wiped clean, and when you promote again, it's going to be reset to those original budget values. Because we're kind of assuming that you're promoting to in progress when the project starts. We don't see a lot of reasons you need to demote backwards. So if you're having to do that on a pretty regular basis, you may want to reach out to your client success manager and maybe kind of see if you can get some alternative workflows, because it really should be a pretty rare situation. But if you do, I would encourage you to come in here and hit view and pull your budget. This is a printable PDF copy. It can also be exported to Excel, and that's going to allow you to memorialize what my at-risk looks like today, so that if I've been doing a great job of keeping up with it, I don't demote and then re-promote and forget where these should be, right? Save myself some effort, go ahead and export that file, and then as you come back to in progress, you'll want to come in and refill out those numbers, adjust each of those. Now, in terms of adjusting these down to 0, at some point in the project, you should be done spending on each line item. At the end of the project, when all work is complete, all of your at-risks should end at 0. I will not be spending any more between now and the end of the project because it is the end of the project. So I would come in here. At any point in time, I can hit the other button and delete at-risk. What this is doing for me is offering me the opportunity to go ahead and check box all the items where I know I'm done spending. I can come in here and make quick updates to say, these 10 items, we're finished spending. We don't expect any more costs there. That's an easy way to zero things out. Same with contractor's contingency. You can go ahead and wipe those clean. We'll talk about foot all cost codes to budget here in a bit when we talk about consequences of mismanagement, because that can be a really great tool to kind of get you back on track. But just know that foot all cost codes to budget does the same thing that the foot to budget button did for a single cost code. We're saying push all my over-unders to 0 by adjusting my entire at-risk column. So let's go ahead and hop back over here, and we're going to talk about our consequences of mismanagement. This is the main reason I wanted to have this webinar, is because I see so many clients that I meet with on a regular basis who have been mismanaging their at-risk, and it really can have some pretty far-reaching consequences for you. So firstly, if you're letting your budget get out of hand, you're not managing that at-risk with some kind of standardized strategy, you're going to get an inaccurate cost at complete value. So you're going to be looking like you're spending a lot more on each line item than you actually are. You're going to get inaccurate over-under projections. Most likely, you're going to start showing falsely over budget in a lot or all of your line items, and you're not going to understand why, because you're double counting that money. Because as I'm putting money into the open and the actuals column, and I'm failing to reduce my at-risk, I'm starting to see an inflated cost at complete, and I'm starting to see false over budget values in my over under projections. Most importantly, we're going to see inaccurate profit margin projections. And that's going to be huge. We're going to go look at the financial overview report because my executive leadership is going to be looking to that report to see whether or not we're going to achieve the profit margin we wanted to for that project. And I'm going to start showing, as I start showing falsely over budget further and further, I'm going to start showing less and less profit. And eventually, I'm probably going to see a false projection of loss on that project. And then even further than that, something we won't get too far into today, but we can get an inaccurate revenue calculation. So this is for folks using the percentage of completion revenue calculation. If you're recognizing revenue based on actual costs to date, that factors in at risk and contingency as part of the denominator in that formula. So it can affect your revenue numbers on even your company-wide reports, which is a great plug. We're going to have another second part to this series, this webinar series next month, which is called Whip Your Whip into Shape. We're going to be talking about company level reporting, and we're going to see how a mismanaged at risk can actually factor into our revenue numbers and affect what we're seeing on our WIP as well. So I would definitely encourage you to sign up for that webinar as well. But let's go take a look at where we're going to see these consequences. So probably the best example I can give you on this budget is right here, demolition, right? I wrote a subcontract for demolition, but I can see right here without going any further that this at risk has been ignored. How do I know that? It matches exactly with the budget amount. It's still at its starting value. No one has made any changes to it, but someone committed $11,075. And so it's showing me falsely over budget. I did not remove that $11,000 from my at-risk. And that's very common. Sometimes your PMs have a pop-up blocker on, and that reminder isn't going to pop up for them when they commit things in the buyout tab. Sometimes the pop-up does appear, and they don't know what to do with it, so they just hit save and move right past it. Right? If you're blowing past those reminders and you're never adjusting your at-risk, you're getting a complete value that is falsely too high. You're getting an over-under value that is showing you falsely over budget. So what I would want to do in this case is open this up and make a realistic assessment, right? I could come in and just foot to budget, but in the end, foot to budget is not going to give you the most realistic picture. If you're footing everything to budget, you're going to be telling yourself, I'm on budget, I'm on budget, I'm on budget. Your financial reporting is going to look awesome. You're achieving exactly the profit margin you said you would, but it's not real because you're hitting that easy button every time. So we want that critical assessment. Now, that being said, if you've been ignoring your at-risk habitually and you come into your project and you realize all your line items look like this, my at-risk is identical to my budget, but I do have open and actual values. So we've been ignoring this. A good way to get started catching up is that foot all cost codes to budget. That's going to allow me to go ahead and say, you know what, just show me what's left in the budget. Do the math for me, give me a starting point. And it's going to force all these over-unders to zero. It's going to adjust your at-risk. And what you'll see is, for this line item, it's essentially going to take 552, 736 minus 11,075 and show you what's left available to get you a zero over under. That's not realistic for all line items, but it's a great starting point. And I can then come in and make tweaks and edits to the line items where I know I'm going to come in over or under. So that's a really nice catch-up strategy. If you use it, again, just keep an eye out for parentheses. If I see negative values, that's a clue that I've already gone over budget. That means if I add up my actuals and my open, they are more than my budgeted amount. And I would need to then assess, am I done spending? And this is how far over I am and will stay. Or is there more spending to be done? And I'm going to go further over budget, in which case I would put a positive number in here. So it should be adjusted to a zero or a positive number. Again, unless you're in the rare case expecting a credit. So that is what we're seeing on the budget. Let's go look at the more important piece, which is what we're seeing on the financial overview report. If we come over here to our financial overview report, what we're going to see is that our profit numbers are being affected. So we'll zoom in here. This estimate at complete section is really where you're going to see the issue. ETC, estimate to complete, is a combination of the at-risk and the contingency columns from the budget. So if I'm not managing my at-risk properly, or for that matter, my contingency properly, if this number is not accurate, my complete is not accurate. My estimate at complete is going to be off, and that's going to throw my variance off. This is my over under. We're just displaying it by cost type instead of by cost code. So remember, we said your complete was going to be probably falsely too high. Your variance was going to be showing you falsely over budget. So what we're getting here then down in profit and loss, or profit margin, is we can see that originally we intended, based on our budget, to achieve an 8.73% profit margin. Based on cost to date, we're achieving 7.19%. Costs at complete, where are we going to be? As complete gets falsely too high, our profit margin is going to get falsely too low, because our costs are exceeding our budgeted value and or our contract value, right? Those extra costs are kind of eating away at our contractor's margin. And then your variance here is going to be showing you falsely under what you intended when you budgeted, right? So we're 1.55% below our target profit margin. So this can be really big, right? If we are managing our at-risk properly, we're getting a really great and accurate picture of where our profit margin will be at the end of the project. But if we're mismanaging it, this report can be really confusing and concerning to your executive leadership. So you just want to make sure, like I said, I can't stress enough that you want a good management strategy, and you want to make sure that your at-risk is on par before someone pulls this report, right? If you know you have work to do, you don't want to pull this report until you go ahead and tidy up that at-risk, and then you know you're getting the accurate numbers you want to see here. And then we'll also talk revenue. Again, if this is revenue as a percentage of completion, which is how this project is set up, that at-risk number does factor into it. And we'll see that in our next webinar, that can affect your revenue number on your WIP and cause you to have an inaccurate idea of what you're eligible to bill, right? So because when I use percentage of completion, I am really kind of calculating based on cost to date what I'm eligible to bill, and that at-risk will factor into that in terms of total cost at complete. So that's really all we've got here. I want to make sure we highlight some key takeaways for you. At-risk is allowing you to reflect the impacts of real life on your project's budget and your profitability. So when you're developing that strategy, just make sure that you're emphasizing, hey, the strategy we use should be allowing those with the most project knowledge to estimate or forecast what those situations, what impact those situations are going to have on our project. We want to make sure we're taking the time to think critically about how much more we have to spend on any given line item at any given moment. We want to manage our at-risk as we go. It shouldn't be something we're getting in there and doing once a month. I would say at a minimum, we should be getting in there and making changes weekly. And most preferably, we would be going ahead and updating it as we commit dollars or as we enter invoices that do not have a commitment. But that periodic review may make sense, and you may need a combo of the two. You might need to periodically review as situations evolve, even if you are looking at those reminders and paying attention to those ones we saw. So find a strategy that works best for your company, write it down, and make sure all of your PMs are using that same strategy so that you can be confident your reporting is accurate across all of your projects. Ignoring your at-risk can lead to a wildly inaccurate financial reporting, right? We just saw that. I can't stress that enough. The number of clients that'll reach out feeling very, very concerned about what their financial reporting says, and they can't figure out why. It all comes down to at-risk most of the time. So from there, please make sure you take a look at our webinar page and sign up for part 2 of this series, Whip Your WIP into Shape. I'm going to be coming back to talk to you about the WIP and company-wide reporting, and we will take this even further in terms of, how does good at-risk management and other key factors give me the most accurate company-wide financial reporting. So with that, I'm not seeing any questions in the Q&A or the chat at the moment, so I will hang around just a bit. Please feel free to put those questions in, and we'll get those answered for you if you have them. Otherwise, we're going to make a copy of this recording and the slides available to everybody who attended, and we will be putting this up as an on-demand webinar, so you can come back and see it on our website at any time. But thanks so much for coming today, guys. Have a great day.